little over 2 years since Russia invaded Ukraine, caused the price of natural gas to skyrocket because Europe gets 40% of their natural gas from the Russians. After that initial spike, though, the price has come down hard, over 80%. It just keeps getting hit. Meanwhile, oil's up almost 10% over the same period. But even though natural gas, the commodity, had a tough time, some natural gas producers are doing a lot better than others. Take Coterra Energy, the Houston-based oil and gas producer that was created when Capital Oil and Gas merged with Cimarex back in 2021. In the past, Coterra has been more natural gas oriented, but a couple of weeks ago, they reported a solid quarter, better than expected production, huge free cash flow numbers. At the same time, management said they'd be cutting back on investments in the gas-oriented Marcellus shale. Price is too low. They have the flexibility to pivot between oil and gas, and that is huge, people. Don't take it from me. Let's check in with Tom Jorden. He is the chairman, president, and CEO of Coterra, big position for my charitable trust, to get a better read of the situation. Mr. Jorden, welcome back to Mad Money.
Good afternoon, Jim.
Tom, this is when your model shines. I mean, there's some people who are in nat gas and they're getting hurt. People in oil, they weren't able to take advantage of nat gas when the prices were higher. Talk to us about how great the pivot is for you and how you know better than to be patient and watch for the recovery gas macro, because missing a few months of the recovery is much better than fully participating in the downside.
Jim, thank you for noticing. We built Coterra to have flexibility of top-tier assets, low cost of supply, but also a team that is nimble, always looking at iterations and ready to pivot. There's another element that's critical, and that is that we've built our service contracts so we don't have many long-term commitments. And that means we can move capital from one basin to another in fairly short order, as we did with our recent release. We feel pretty solid about where we stand.
Now, one of the things that I think people don't understand about oil companies is they tend to be very episodic. The idea of getting a 6-month projection is really hard. Whereas you get a consumer packaged good companies, they give you a pretty steady dividend increase. You know what you're going to get. They give you a 2-year outlook. You're giving us a 3-year outlook and giving us a return of capital. We can really budget. Our individual investors can budget Coterra like they would be any great consumer products company.
Well, because of our asset quality and also our organization, we can project a stability of revenue and stability of cash flow that gives us that luxury. We can never predict commodity prices, at least maybe there are those that say they can. I've never known anybody that could. And so we keep our debt low, we keep our assets low cost of supply, and really build an organization that can capitalize on it.
Well, let's talk about the scale of what you're doing in oil this year. Now, you told us last year, look, you can't just pivot in a quarter. But it seems like that you're going to be doing, with the couple rigs you have, a huge number of wells are going to be drilled. I know you don't gauge toward production, but the possibility is that you could have a really bountiful year if oil stays high.
Well, we always hope for that, Jim. We don't manage a company by production growth. We manage it by capital allocation in the most profitable places we can invest. But we've just got some tremendous projects in our oil assets, particularly in the Delaware Basin, where we have these large projects that really give us capital efficiency, economies of scale, and set up the future quite nicely.
One of the things you pointed out, you have a lot of jocular moments in your call, many more than everybody else. But the Journal has a story every week about these companies merging. Now, they happen to be very fine companies. I happen to like Diamondback. I like the acquisition. I like Chevron. I think that nobody's better than Sheffield other than you. But, aren't they getting a little carried away? All these mergers, are they spend enough time thinking about this?
The real question to ask yourself on any transaction is, what's better, a share of the company you have or a share of the combined company? And we've looked at a lot of potential combinations. Everybody has. But we feel pretty comfortable where we are with our inventory duration, our low cost of supply, and our ability to execute nimbly. We're always going to be opportunistic. We'll always be curious, but we like where we sit right now.
Now, a lot of the commentary about the Permian is that it's peaking out. I just don't see that, but I rely on people like you to tell me about whether it's more bountiful than a lot of these journalists and a lot of the, I would say, the armchair critics say.
The Permian Basin has been described as a very forgiving basin, and believe me, it's forgiven us a long time. And we find that with a emphasis on technology and innovation. And Jim, you know what a technology business oil and gas is today. Right. We find that we continually push the margin, we continuously improve, And I think we're going to see that for some time to come.
Now, the Anadarko, it's not an aggressive ramp up, but a lot of people are very skeptical. You apparently see this, and I know you told me this last year when I was in Dallas, that Anadarko could be a very bountiful area.
Anadarko is tremendous. It's high pressure, great quality rock. It also has natural gas liquids. So in addition to the natural gas, we have natural gas liquids, the butane, the propane, the ethane, and so on, that really adds to that revenue stream. It's a tremendous place to operate, and we've got some really nice things to do there.
In the meantime, I saw EQT. Look, EQT is a really good company, but they cut back too. I imagine you're watching all these people cut back. There'll come a moment we'll get some cold weather, or maybe something, unfortunately, I hope doesn't go wrong in Russia, but you will be able to ramp back up much faster than the other guys, correct?
Well, time will tell. I think we're well positioned. As we announced in our plan, our production will decline single digits, 5 or 6% this year. But we have contingency plans to ramp back up if things look better. You know, the thing, we've taken a little different approach. We've never been able to make sense out of shutting production in. What we want to do is not invest in future wells. At least put a pause on that and redirect that capital to other assets.
Are you surprised that natural gas has fallen as far as it has?
Well, I am, but you know, it's simply until we get more LNG exports opened up, we're in the weather business, and we didn't have the kind of winter that we've had the past few years, and storage is in good supply. So you know, this is just part of managing the business, and that's why we have the ability to pivot from one asset to another. This is kind of what we are designed for.
And then last question, are you surprised that when an OPEC does something like they did, extending the cuts, that it just doesn't seem to matter anymore?
Well, OPEC is still going to be underwriting oil prices for some time to come, but I think there's been a psychology of supply in the global marketplace that people just don't worry about the way they used to. I mean, there was a day when any shock in the Middle East, and Lord knows we've seen lots of them, would have made a huge volatile change in the price of oil. And to be honest, Jim, that's a credit to our industry. I think we've created that psychology of security of supply, and we're going to continue to do it. Well,
you're a big part of why we have energy independence and have security more than we've ever had. And I want to thank you, Tom Jorden, Chairman, President, CEO of Coterra, just doing a fantastic quarter, and I think it's going to be a great year for you. Really great that you're on the show.
Thanks, Jim.
Talk to you soon, Tom. Thank you. Mad Money's back after the break.
Coming up, investors crave dividends, and these companies are putting their money where their mouth is. A special year-to-date dividend delivery next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.